I think a lot of people aren't looking at reshoring. Again, I think reshoring longer term, zoom out's the right thing to do. I think it's right for the economy. I think depending on people that don't like us, or at least not dependable, is a stupid idea.
Yeah.
But it will come with inflation. You pay an American more than
Yep.
you pay someone in China. It's just
Listen,
math. As someone who watches a lot of YouTube and watches a lot of interviews, I stumbled across an interview between Ryan Pineda and Rod Khalif. I'll go ahead and go over to Ryan Pineda's podcast or YouTube channel to see that full interview. It was nicely done, gentlemen. But what I wanted to do was get into one of the topics with Jonathan Twomley, because again, he comes on this channel one rental at a time. He tells us the truth. He gives us an opinion about an area that I do not play in, and that is big multifamily. So let's welcome Jonathan to the show. How you doing, buddy?
I'm great, Michael. How are you?
I'm doing really well, man. A little tidbit here. The inflation readings came in this morning lower than expected. I don't know if you saw that, but headline, core, month on month, year on year, all four were below expectations. So you know what that means, right?
That means everyone's going to go crazy talking about rate cuts coming. Yes.
Yeah, I just checked right before we started. The market going into CPI had a 75% rate chance of a rate cut in September. It's now 87%
Wow.
chance of a rate cut in September. More on that in a minute. But the reason why I wanted to bring that up, the market, is one of the points early in Ryan and Rod's conversation was about the pain in syndications. You and I, well over a year ago, highlighted the pain that was coming. It is undoubtedly here. There's a lot of people in trouble. There's a lot of people trying to do loan workouts, extend and pretend, all of that. But where I wanted to go with this is Rod at least made me feel that he thought Fed rate cuts could save deals. And I just don't think that's the case. I think a measly quarter point or half point is not enough to save deals. I think there's so much pain that has to be realized that, even a half a point cut here this year won't save deals. But maybe I'm wrong. So I thought I'd ask you.
Yeah, it's not going to save deals except at the margins. And it will not save deals that were bought at the top of the market with 3-year bridge debt, right? There's just not enough, meat on the bone there to make, there's just not enough equity cushion really in those deals to make much of a difference, right? I mean, if the Fed is not going to go and cut like 2 points and get back to the interest rates at which people were borrowing and which they underwrote their exit from bridge debt, right? They underwrote their refi at, probably something with a 4 handle on
Right.
it if they were
Or four and a
conservative.
half. Right.
I mean, and I guarantee you there are probably people out there who are underwriting their refi with a 3 handle on
Oh,
the debt. Because there were people getting 3% rates
mhm.
for their debt at the top of the market. We're not there now. Like right now, rates on multifamily are in the 6s and 7s,
Right.
and a quarter point or a half point is not going to bring it down into a range that's going to save most deals. Now there may be deals that are on 5-year debt right now where they've had enough time to grow their NOI a bit, and maybe if they do some amortization, and they might be the ones that kind of,
Well, let's talk
they're
about that. Let's talk about that a little bit, because I think you're right. Because if you think about 3-year bridge debt, you probably had something sub five, and now
oh,
you're right.
way below 5. Yeah,
Yeah.
way below 5.
But if you have 5-year debt, that means you're probably in 2019. I was doing, little onesie twosie stuff then. Weren't rates like 5% in 19?
I think for commercial, so generally they're a little bit lower for commercial than for
Okay.
residential. So they were probably in the 4s at that
Okay.
point, right?
All right.
And um, maybe even the low 4s at that point.
Okay.
And um, so, but still, there's a big delta, right?
Yeah, there is. Yeah, for sure.
Between now what you hope for if you bought a deal in 2019 with 5-year debt is that you've had 5 years to grow your rents. You've also done some amortization. And if that's the case,
You might
then
be okay. Yeah.
you might be okay. And a rate cut will definitely help you, right? But um, you know, it's not going to save the industry. It's just going to save some deals. And I don't think anybody's out there projecting more than like a 25 basis point cut, right? I mean, I don't think anybody's out there saying there's going to be a 50 bip cut, right?
Mm.
So, 125 basis point cut in September, it's really only the people on the bubble that you're talking about are really going to be helped by that. And most people
Yeah.
won't be. And it's not going to help the bridge debt guys. All the people with bridge debt, I mean, those people were getting SOFR plus, plus the spread. And
Right.
and it was, those rates were like super, super low. And
Right.
their whole underwriting depended on that. And they're just not, it's just not going to help them with rates where
Yeah.
they are.
Yeah. When I was hearing that conversation, and maybe it's just how I interpreted kind of reading between the lines, but yeah, I don't see a quarter, even a half a point saving the deals. I've gone back and looked at, there was record deals done in 2022
Yeah.
on bridge debt. And
Yeah.
and it really was a game of musical chairs. And unfortunately, there isn't a chair for you. There's pain coming, and there's pain for everyone. I think the equity's gone. I think banks are taking haircuts. I still think in that space, we're seeing more and more Class A stuff trade, which makes me feel like, okay, we're starting to get into this. But I haven't seen a Class B, Class C really trade of substance other than a couple of foreclosures. We have a long time to go. It's not over yet.
Yeah, I agree with that. I mean, and you know, the banks were basically out in 2022 because
Yeah.
they just couldn't square the circle with their DSCR tests. And with the debt that you saw being lent was bridged at sometimes a DSCR of like 1.05, right?
Yeah,
And
crazy.
so these deals were super leveraged, and the whole assumption was that this low interest rate environment would continue, like the super low interest rate. I mean, if you think about it, it's so funny. Even I didn't really kind of fully think this out at the time, but the super low COVID era interest rates, like, did anybody expect the super low rates to continue indefinitely? I just didn't give it much
Apparently,
thought at the
some people
time.
did.
But apparently, yeah. So I mean, even that was just a crazy assumption if you think about it. Like because even just going back to pre-COVID rates, which were already
Not
super
bad.
low,
Yeah, they weren't
yeah,
bad.
they were no, not bad. They were great. I mean, those were great rates. The thing is that even going back to those rates would cause a lot of pain. Like you would have had to,
Oh
on a
yeah,
lot of these C-class deals, really execute your strategy, really get the rent bumps that you anticipated. And a lot of that is just out the window because with all of the supply that came on in the same markets, right?
yeah.
This is the thing that people have to understand. It's like, I guess if you did a C deal in Milwaukee, right? Maybe you were going to be okay in this if the assumptions held true because there wasn't a ton of supply coming on in a market like that. But so many of these deals were being done in precisely the markets where all the supply was also coming on. So Phoenix, Las Vegas, the big Texas metros where everybody was investing. Those places, like you're just you're in your C deals now, you're competing with the B deals, which are competing with the A
Yeah,
deal, right?
exactly.
And those rent assumptions just aren't coming true. So given that everything depended on those big rent bumps that people thought they were going to get from executing these plays, um, that was how they were going to exit and get the debt that was going to be, you know, more expensive, if not the same. And it's just not there. Like those rent bumps are just not there. So I think, as we've talked about before on this channel, it's not, interest rates are not the only problem, right?
Mhm.
There are basically three different problems that all happened at the same time, which is increased supply. So rent growth was gone and rent declines are actually happening in a lot of these markets. The second thing is the explosion of costs, because in these same markets, you got, because of the way that property taxes are valued, huge increases in property tax, plus huge increases in insurance, plus a tight labor market, meaning that labor expenses were higher. So basically your NOI was getting whacked, right? So all three things at once, right? Lower rents, higher expenses, and higher interest rates. So basically, without solving all three of those things, a lot of these deals are in trouble. And so just getting a couple of bips of relief on interest rates is not going to help. If you have, even if interest rates were your only problem, right?
Yeah. The other thing I want to give credit to Rod for really bringing up, and Rod and Ryan talking about, is basically lots of pain. Lots of pain equals lots of opportunity, right? There is a general understanding that deals done in the last 3 years are in trouble. Lots of losses coming, but also the next 3 years, if you just kind of mirror the 3-year period, could be, life-changing opportunities if you kind of zig when others are zagging. Do you feel the same way?
Oh yeah, it's funny. I was actually thinking about this morning in the shower, and then saw someone post on LinkedIn about the same topic. So it's just clearly like what people are thinking about. But what I was thinking was, there's so many people right now who are saying, "Oh, it's not a good time to invest because it's a high interest rate environment and stuff like that." And that really makes, I mean, it makes sense on a very, very surface level, but it doesn't make any sense when you think about it. Because if you're investing in a high interest rate environment, your risk that interest rates are going higher is very low, whereas the chances that interest rates are going lower is pretty good, which means that your chances of like meeting your exit assumption are better now than they are when you're investing in a low interest rate environment. And it made me think back to when I first started out. I mean, interest rates were good. They were in the fours, right, for multifamily. But everybody, and I'm talking about 2013, 2014, everybody you talked to at that time, the assumption was interest rates would be higher in 5 years than they were then. There was literally nobody out there saying, "Oh no, interest rates are going to be lower in 5 years than they are now."
It's funny
And
you bring that up. One of my advisors, right around the same time, he's like, Michael and Olivia, one of the things I recommend you do is lock in as longer term debt as you can, because
exactly,
his opinion
yeah,
was rates were going to go up. Yeah,
right.
I remember that.
So, and that was what we were doing. We were like, okay, these interest rates are
Get
great.
10, not 5. Yeah,
Right,
exactly.
we're going to lock it in for 10, right? And the reason that you want to do that is because, you want to have enough runway to grow your NOI to make up for the decompression in cap rates that you're going to get because of a higher interest rate environment. And so that's what you do. Like when interest rates are low, you try to get long-term debt, right? And but when you're in a low interest rate environment, right, your risk is that interest rates are going to move against you, right?
Right.
And so that was what people really weren't taking into account at the low end of the interest rate spectrum. And so people now, like when they're saying, "Oh, it's so much easier or it's better to buy when interest rates are low," well, yeah, but you got to lock in the debt long term because the chances are their interest rates are going to move against you, which is exactly what happened. But right now, it's the other, you could.
Let me ask you about that, because I wasn't looking at deals, and let's call it 2022, the low of the interest rate
Yeah.
cycle. What was the interest rate, again, best guess, best memory, kind of, the 3-year bridge debt versus maybe a Fannie Freddie 10-year lock? I guess what I'm asking is, how big a spread
Well,
was that?
I
Do
don't
you
think that
recall?
I don't think the interest rates were that different. I don't
Okay.
think that was the issue. It wasn't so much the interest rate spread. It was that the bank Franny and Freddie and the banks were DSCR constrained. They were
Right. They were
proceeds
out. They
constrained.
were out of the
So
market. Yeah. Yeah.
yeah,
I got
so
it.
they couldn't give you 75 or 80% leverage like the bridge debt lenders were willing to do.
Gotcha.
They
Gotcha.
could only give you, they were, and I wasn't willing to do bridge debt because I thought it was just sort of frightening. But
Right.
the
Yeah.
the
Yeah. I agree. Couldn't
but
do it. Just
I was
couldn't do
going
it.
to my mortgage guys and saying, what can you get on this deal? And they were like, we can get you 60-65%,
Uh,
right? And because that's where the agencies would be on those loans, right?
got it.
Because of the DSCR, because basically these deals were so
Yeah. They were
overpriced
skinny. They
relative,
were
yeah,
overpriced. Yeah.
yeah,
Exactly. Yeah.
relative to the NOI, right? And
Yeah.
so That was what happened, right? So so those traditional lenders were really out, except for people
Mhm.
who were very conservative and had a lot of
Yeah.
cash, didn't have to go raise cash from investors and stuff like that. So
Mm.
um, that was why everything was done on bridge, and even deals were being done on bridge that weren't really ripe for bridge debt, right? They were
Mm.
just, it was just substitute for permanent debt. Just, well, let's hope to get through the next 3 years and then get permanent debt on here.
Right.
But people were not, it was classic euphoria. They were not expecting there to be a downturn. They were not
Mm.
expecting to have to, you know, like guard against an interest rate rise. And if you talk to people, I mean, I talked to mortgage brokers who should have known better, who told me straight up,
Mm.
interest rates cannot go up because of, like, pick your reason,
Yeah,
right?
XYZ.
Yeah.
I'm curious. I think this is true, but I'll ask it anyway. Is it fair to say that this bridge debt, this whole, I don't know, that whole function of those bridge debt providers would be kind of non-banks, right? That would
Yeah.
be this shadow banking, if you want to call it that. That's outside of bank regulation. Is that true?
Yeah. Yeah. These are non-banks. They're um, hedge funds, PE funds, funds that are debt funds, they're just set up for the purpose of lending.
Yep,
And
gotcha.
that's all they do. Yeah.
Yeah. So one of the things that I think is very interesting, because again, going back to the opening of this call, CPI came in light, the second month in a row. CPI headline now is 3.0, core is 3.2. People are upping the odds for rate cuts in September. I just want to put it out there that I think one of the things that Powell, if you were to give him a shot of truth serum, is he wants to kind of break the Fed put. He wants to break
Yeah.
shadow banking. And I don't think he's going to be in a rush to cut in September. I've always guessed that he would wait one extra meeting just to kind of squeeze that last bit of pain out of the shadow banking system. Am I off base, you think?
Yeah, no, I actually agree with that. I was going to say that I would be part of that, like 15% or 13%, whatever, that says
Yeah, no
no rate
September.
cut in September. And and I think, everybody's talking about how his language has turned dovish, et cetera, but they're forgetting the fact that he said in, like, one of their previous calls, essentially, we're going to really make sure that
Yeah,
this
we're
isn't that.
really, really
Yeah,
going to make
yeah,
sure.
like
Yeah.
that this is not like a data head fake
Yeah.
before we start cutting. We're not going to go and reignite inflation, so
Yeah.
I
He's,
think
he's scared of the early 80s, right?
yeah, I think the risk is to the Fed waiting too long rather than cutting
Mm,
too early,
yeah.
um and frankly, I don't think that, yeah, if unemployment goes to 5%, I think the Fed would view that as a good thing, not as a,
Really?
well, I
Yeah.
mean, you know what I mean?
Yeah.
Like, not
Yeah.
because they would say, look,
If you zoom
traditionally,
out, right? You zoom out. Yeah.
yeah, yeah, traditionally 5% was considered,
Full
full
employment. Yeah.
employment. And
Certainly was.
we've had sub full employment for a long time now. And, that's why we're kind of, we could afford, quote
Yeah.
unquote, afford higher employment as long as everything was getting made in China, and we were
Hmm.
basically like, they were, exporting our inflation to China or vice
Right.
versa, importing their deflation.
Right.
But now that, if that is not, if we're reshoring everything, then we're going to have more inflation, and we need to have a
Yeah.
higher unemployment rate.
I agree with that. I think a lot of people aren't looking at reshoring. Again, I think reshoring longer term, zoom out's the right thing to do. I think it's right for the economy. I think depending on people that don't like us, or at least not dependable, is a stupid idea.
Yeah.
But it will come with inflation. You pay an American more than
Yeah.
you pay someone in China. It's just
Listen,
math.
I wanted to actually, can we riff on this? I know you got to
Go
go
ahead.
soon, but I was
Yeah.
I was really thinking about this issue too, that, we so we sent all the good manufacturing jobs to Mexico and then to China, right?
Okay.
And
Yep.
and like, what happened as a result? We got the hollowing out of small towns and cities
Yep.
around the country, right?
Yep.
We got a lot of, like, really bad political dissension as a result of people, losing good manufacturing jobs and having to
Yep.
work service jobs, right? A lot of where we are right now politically is a direct result of 20 years of like sending the good jobs away somewhere else. And the trade-off was, well, you get to buy everything cheap, right? And who did it really benefit? Like it benefited the 1% a lot, right? I mean, they were the ones who really, if you can basically manufacture your stuff in China
Yep.
for a fraction of what it costs you to make it here and charge the same amount, the delta all goes to you, right? And it doesn't, and the workers are the ones who get screwed. And
Correct.
so we, like, as a society, we have a trade-off to make. Like we're either going to have things cost more, but have like a healthier, that's the price of like a healthier society, or things cost less and kind of deal with the stuff that we've been dealing with for the last 20 years. And
Yeah.
like, we can't have both. And
No, you can't. No.
we were fooled into thinking that we could have both, but we really can't, because it was the hollowing out of like the lower end of society that, the upper 80% were just like ignoring. And, now the chickens have come home to roost, essentially. So we're going to have
It's
higher
funny
inflation.
it's funny you bring this up, because I haven't given this much thought, but just riffing on this. If I zoom out like a decade, because that's how long it's not going to be a quarter or a year, it'll be a decade. If I were to just use my magic wand, I think Powell and his 17 cronies or 18 cronies on the Fed board, they want to take this cycle down to 2% because it's kind of like for like, right? We're still in this environment. But over the next decade, I think they're going to start accepting higher inflation because a larger percentage of our economy will be manufacturing based if this goes the way I think. And, we've talked about, Fed's now not talking about 2% target. They're talking about 2% average. There's a lot of talk about, hey, should we take the floor from 2 to 3? I think all of those are on the table and probably should be on the table, right? Is 3% inflation good to build the middle class again? Yeah. I think I think that's a fair trade. And I think that's something that could be on the horizon, for the next decade.
Yeah, and 3%, I mean, 3% was always just the assumption of what inflation was, right? Forever. I mean, you and I, when we went to college and studied economics, like basically the long-term inflation was 3%, and that was seen to be like, okay,
Yeah,
that's
it was
acceptable
okay. We could deal with
inflation.
it. Yeah.
You need some inflation, right? You have to have some inflation in the economy, but you don't want to have too much. And then suddenly, after Greenspan, it was kind of like, oh, 2%. I remember actually being surprised when the Fed's target became 2%. And I was like, why
Where'd that come
2%?
from? Yeah.
Yeah, right.
Yeah. Well, I think because I studied this a lot in school, and I think 2%. And again, you can actually look this up. 2% actually was in a paper by some no-name economist, decades ago. I think out of Australia or New Zealand. Like, why does a New Zealander? I have to go back and check that out to make sure. But anyways, 2% was just it was accepted because we had been below it for so long.
Right, right.
Right. It like we'd had a one handle on it for like 12 years or something. Or they're like, oh, we're never going to get to 3. Let's try 2.
Yeah.
It was kind of weird. But the last thing to kind of talk about here as we wrap up this episode is I'm starting to think Ken McElroy is even more right. I've been thinking he's doing the right things. He's talking about all this construction not happening. There's a channel called The Uneducated Economist who's a lumber guy. He's talking about lumber crashing, the cash price being below the spot price. And I think what's really going on, given this quote unquote high rate environment, is we're just not building. And yes, we have more supply, and yes, we're giving rent concessions and all of that, but there's nothing new coming. And given the length of time to build, we're going to have a huge gap of years before
Well,
anything net comes. What do you think?
yeah, no, I mean, that's true. And this is essentially like the real estate cycle, right? This is just, if you go look at what Glenn Mueller unpacked a number of years ago, this is it. We're like living the cycle, and this is what happens every time. But the problem is we just haven't seen this for like 13 or 14 years,
Right.
right? But you had the same kind of like overbuilding, and it just happens every time. When credit
Yep.
is easy, it's easy to build, everybody builds, and then you hit that point where suddenly the vacancies shoot up because there's too much supply. And then banks
Then you
look at
stop
that and they're like, oh,
building. And
then banks are like, uh-oh, pull the plug, no more lending for you. And then it just like almost overnight it stops. And
Yep.
then what you have is the overhang that's already in progress gets built, right? And then when that finally gets leased up, it'll take a couple of years. then the banks will look at the situation and be like, oh, look, vacancies are shrinking. We'll start lending again. And of course, it takes 2 years from the time they lend for that supply to hit the market. So rents will rise, and then it just fuels the whole cycle. Then everybody looks at that and they're like, let's jump in because look how good it is. It's the issue, the reason that we have the cycle is because of the 2 to 3 year lag time between a project,
Love it.
like getting permitted, like between the time that you get the money from the bank and the time that you get units that can be rented. That's why we have a cycle, because it's always behind. It's always
Yeah.
behind.
Love it. Again, at the end of the day, folks, what I'm doing with all this information is I am starting to shop. I'm starting to network with bankers. I want to, add some 5 to 50 units in my portfolio. I will likely 1031 out of houses or duplexes into these. It's what I've been building the last couple of years. I've been sharing the plan with you on this channel. So I have receipts, a lot of fun. Jonathan, where can people find you?
Yeah, come follow me on LinkedIn. That's where I'm most active these days, and you can, DM me right there. So if you want to chat, hit me up.
Awesome. Thank you, buddy.